If you work in the tech industry and receive restricted stock units as part of your compensation package, then this video is for you. Restricted stock units, or RSUs, are the most commonly awarded type of equity compensation, and they are in many ways the simplest. That doesn't mean that they're simple. They are just more straightforward than things like stock options and employee stock purchase plans. If you have just received your first grant of RSUs, there's a lot to learn. It can feel a little bit overwhelming, and many of the terms you might not be familiar with. So we're going to cover some of the basics about how to think about your RSU grant and what the various terms mean. First and foremost, restricted stock units themselves just mean that they are restricted because you are not given all of the stock up front. You have to wait over a period of time for all of the stock to vest. So they're restricted in the sense that you do not receive all of the stock at once. The stock unit part of that term just means that your company is actually giving you stock in the company as opposed to cash or some other type of bonus. So the restricted stock units, if you have just started in a new role, you might have received a grant. In that grant, you are told how many shares you are going to be receiving and over what period of time. So the period of time over which you might receive them is called the vesting schedule. So your shares will vest or be given to you over a period of usually something like 4 years. If you have received a new grant of RSUs, you might get something like 25% of them after 1 year and the remaining 75% vesting over the remaining 3 years, quarterly, monthly, or semi-annually. So that's a little bit confusing, but essentially instead of getting 10,000 shares of your company stock on day one, you're getting those 10,000 shares spread out over 4 years. Again, that could be monthly, quarterly, semi-annually, and oftentimes you have to wait a full year before any of the shares vest. So what happens on the vest day is the company now takes the shares and deposits them into the custodian that they're using to administer their plan, usually E-Trade, Fidelity, or Schwab, and you now have access to those shares. A couple of things will also be happening on that day. Number one is now those shares are taxable income to you. So if you have received 10,000 shares of your company stock, that is 100% going to show up in your W-2 income for the year, and you don't have a whole lot of control over deferring that income or what the amount is. It's just going to be whatever the share price of your company stock is that day times 10,000 or however many shares are vesting. The other thing that's going to happen on vest day is your company will sell some of the stock most of the time. They will sell some of the stock and pay federal income taxes on your behalf. So because it's taxable income, they will sell a portion of the shares and turn it into cash, send that off to the IRS, and that's what's happening sort of on the tax front. One thing to keep in mind with that transaction is the company is typically withholding taxes on a federal level at 22%. That is the standard and minimum required amount for the company to withhold. What happens for many people that are receiving RSUs is that you're not in the 22% tax bracket. You are more than likely in the 32, 35, maybe 37% tax bracket. So if you are not paying attention or sending the IRS money on your own, you might get a very big surprise tax bill at the end of the year because you've been under withholding on your RSUs by potentially as much as 15%. So that is one really important thing to understand about how RSUs are taxed. They will be taxed to you on the vest date and whatever the value is the day that the shares vest. The company will sell some and pay taxes on your behalf, but they probably aren't selling enough. There are some plans and some custodians that will allow you to change the amount that's being withheld on that vest date. So some plans will allow you to change the tax withholding rate to 35%, for example, but not all plans will even allow that. So if that's not an option in your plan, you may have to make another allowance on the side to just be accounting for that extra tax that you will owe at the end of the year. And you may also want to be making estimated payments throughout the year rather than waiting till the following April, because if you're under withholding by a lot, you will also be paying penalties. That's a little bit about what's happening on the vest day. Once they have been given to you, these shares, you now have a decision about whether or not to sell them or hang on to them. And in terms of taxes, if you keep the shares beyond the vest date, at which point they've already been taxed and hopefully the tax has already been paid, if you hold them, you now will be looking at paying either short or long-term capital gains based on whatever the shares have grown or lost since that vest day. So for example, if your shares vest at $100 a share, you hold on to them for 6 months, the shares are now worth $130 a share. That $30 of gain is now taxable, and that gain would be taxed at short-term capital gains rates because you've held it for less than a year. So the short-term capital gains rates are the same as your ordinary income tax bracket. So whatever that is, again, if it's 35 or 37%, in this case, that 30% gain would be taxed at short-term rates. If you hold the shares for more than 12 months, you would pay long-term capital gains rates, which is usually lower, probably will be either 15 or 20%. So that, again, that $30 gain that we're talking about would be taxed at 15 or 20% if you hold the shares for more than 12 months. For many people, I recommend selling their shares as soon as they vest. And there are a couple of reasons for doing that. One is you don't have to worry about short and long-term capital gains because you're just selling as soon as the shares vest and the shares have already been taxed on vest day. So you do not have to think about the subsequent growth or loss that the shares might see if you sell the day that they vest. The other primary reason for selling on vest day is that you run the risk, if you don't sell and you just let your shares accumulate, you run the risk of having a significant concentration, which just means a large percentage of your portfolio could be in your company stock. And that just opens you up to increased volatility. So anytime you own any single stock, whether or not you work at the company, there's a greater chance of volatility than if you were invested in something more diversified. So for many of my clients, I do recommend selling as soon as the shares vest. And from there, we can either fund other goals, whether that's college or retirement, put the funds into something more diversified than a single company stock. And then you don't run the risk of the stock concentration that I was talking about. There's lots of different factors that go into how to decide what to do with your RSUs. But another consideration and one way of framing all of this that I think can be helpful is thinking about it just as a regular bonus. So if you were given a bonus by your company and, say $30,000 cash bonus, I always ask, would you turn around and use that $30,000 to buy your company stock? The answer is almost always no. I suppose some people might be really bullish on their company stock and take a cash bonus and invest it. But for most people, they would choose to take a trip, fund a house project, save for their kids' college, something like that. And so I would encourage people to think about your RSUs in the same way that you would think about a cash bonus and use that in the same fashion rather than getting too caught up into what's my company stock going to do, whether it's going to go up or down. So we've talked about vesting and grant dates and a little bit about the tax implications. There's a lot to understand in this realm, so we're really just scratching the surface. But if you have questions, I'd love to hear them. Feel free to drop them in the comments, or you can reach out to me at zinafp.com, and we will continue our series talking about the other forms of equity compensation.